Alright folks, welcome back. Late night with ICT today, so I was a little delayed in my personal life trying to get things finished so I can get down to business with these charts with y'all. So this will be the last review for this week. I'm going away for 2 weeks vacation this weekend, so I have some preparations to do before I do that. Plus it's non-farm payroll, and if you're not familiar with what that is, the non-farm payroll employment week, we do not like to trade that week after New York session on Wednesday, and that will be tomorrow. So also this week, it just is a first week of August, as I mentioned last night in the lecture and commentary. I'm not really a fan of the month of August, so I know there's a cat in the comment section saying August is just like every other month. No, it's not, but you're welcome to believe that. Yes, there'll be movement up and down, but for high probability, very low resistance liquidity run signatures, which is what I like to look for in trading, they're few and far between on the month of August. So, with that said, in the S&P daily chart, September delivery contract, last night I gave you an outline suggesting that we would likely draw back down into this area between the open of this candle and the close of this candle. And we dug back into this old low here. And we'll see what it wants to do now. Okay, so I don't have any prognostication to share with you today. It's just a review. Hourly chart. You can see we had our old fair value gap here I shared with you last night. We traded back down into that once more, just breaching that low here, then rallied and failed to go above this short-term high. So this is again the reason why I don't like to do trading in the first week of August and or expect a whole lot in terms of precision for August, because it's just a really sloppy month in terms of price delivery. Again, there will be volatility. There's always some measure of volatility, but to me, I'm looking for something that's symmetrical, something that's very clean in its delivery. And if it's not symmetrical, what do I mean by that? If it is not easily outlined on one-sidedness and the market creates very obvious imbalance, obvious liquidity pools, those two things, those two factors in price action, those signatures I'm looking for, if they're not obvious and just obvious in price action, I'm going to refrain from trading. And that's usually what I do anyway, but in the month of August, it's generally like that a lot. So it is what it is. So we see we had a failure to get above this short-term high. We broke down order block, last up close candle prior to this move lower here. Traded back up into that. That's what this red line is here. And recall that 4107 and a quarter level. Okay, that's going to be a factor again when we look at the morning session. Keep this on your chart. That might be pertinent to the rest of the week. 15-minute time frame on SPOOs. We had the market drop down into, again, that fair value gap. We rallied up, and we're going to break all of this down here in a little bit more definitive manner. But there's a small little gap right here. You can see that there, and it rallies up, and again fails to go above that high. Zoom in on that 15-minute time frame. We can see that hourly bearish order block. It runs up into it here, breaks down, creates a small little gap here, redelivers to that fair value gap, drops once more, creates another imbalance here, so re-delivers to the top of that gap, start to break a little bit lower, and back into that old fair value gap I gave you yesterday. On the 15-minute time frame, applying SMT divergence, so the ICT SMT is adding NASDAQ to an overlay, which is on TradingView. If you look up here in the upper left-hand corner, you'll see like a little plus symbol. Click on that, and you'll be able to add whatever symbol you want, and click on New Pane. And New Pane will plot it down here. And then somewhere in here, I hover over here with my mouse, and it'll give you like a little gear. Click on that and change it to plot the instrument on the low. So what I'm showing you is the comparison to these lows compared to the lows of NASDAQ. So S&P went lower, NASDAQ failed to make that lower low. So there's a SMT divergence. So we're seeing the completion of that fair value gap being completely redelivered and just outside of it here, while at the same time NASDAQ was unable to make that lower low that was comparably seen with S&P. And then we had displacement to the upside, shift in market structure, fair value gap drops up into it once more and rallies. Now you don't see it here, but that 41.07 level is in here. Okay, that's the old imbalance that we've been following as a upside objective, but we went above it, so now that level is going to be a factor again. So let's take a closer look at that. So here's that 41.07 level. Here's that low during the AM session. We rally, short-term shift in market structure, fair value gap. We drop down in, return back to 41.07 real support resistance, folks. Rallies again into a fair value gap. And also notice that we failed to get above these relative equal highs. Again, that's an August signature. It's going to sometimes fail. That's why I don't like to trade this month. It's also a characteristic of a non-farm payroll week, where we expect it to be a little less stellar in its delivery. Not just the S&P, but Forex as well. So we have the midpoint of this last up close candle. That's the mean threshold. And you can see how the bodies of the candles dig right into that during the PM session. Then once we broke lower, below the fair value gap, we bump up into it once more. And then we start to sell off. And then the PM session moves, as I mentioned here. On a 5-minute chart, you can see all of the price delivery here. Now, before we get up into that 15-minute time frame fair value gap here, we're going to look at the 5-minute, 4-minute, 3-minute, and 2-minute. We're not going to drop down to 1, but we'll drop down from 5 down to 2. And I want you to take a look at the price delivery in here in relationship to each subsequent lower time frame chart. We have sell side liquidity here, relative equal lows. We drop down into that, we rally. In here, there's several candidates that you could have used for a shift in market structure. You have this one here on the 5-minute chart, if you're not going to use this one on the 15. So you have this one here. Then on the 4-minute chart, again, similar, that short-term high here. Why am I picking this one and not that one? Well, I like the fact that this one is part of these 3 down close candles, and it's the highest of them. And it's a swing high where we have a higher high here, lower high to the left, and a lower high to the right. So that swing high here, that would be your shift in market structure right there. It does not need to close above. Fair value gap here, drops down in, rallies, and then it goes into that 15-minute time frame fair value gap. If you look real close, there's a smaller little one right in here as it runs back into that old 41.07 level. Again, if you're familiar with the last several discussions and lectures and charts I've been sharing, you'll know what that 41.07 level is. That's why it's important to take notes. And the 3-minute chart, we have the fair value gap here, measuring the low here to that high. Now, why am I doing that? Because we've seen a stop run here. So I'm not interested in just this and all that movement down here. I want to see a real price swing. So we drop down here and then we run. There's our imbalance. So what is this? Intermediate term price swing. There's the imbalance. It drops back down in. That could be a buy right there. And then we can use this one over here for the 15-minute time frame. But this is your model, quote unquote, entry for this morning session. And the 2-minute chart, it has its fair value gap here, measuring again that low to that high, equilibrium, trades to it here, and the fair value gap is within that vicinity as well, so that would be your buy using a 2-minute chart if you're refining it further and further. So you could be a buyer here with a stop loss just below that low here, or for safe, conservative stop placement right there. That might be a little bit wide for you, but it's still sound logic. All right, dollar index I mentioned last night. And again, let me preface it by saying I already stated I was not trading this week. Okay, I'm not doing anything the rest of the week. I'm not doing any kind of demo trading. I'm not doing any kind of live trading. But I mentioned how if we break below, watch under here, because we have this order block as well, but it could bounce. And the conditions that would cause that bounce is if we see the euro do what I said it was going to do there. Okay, so I had limited expectations on the upside for euro dollar, but should it trade to that level, and we'll see it in a few minutes, then this would obviously cause the dollar to rally. So we had that little bit of bounce, okay, and I don't know if it wants to continuously run up in here and clean up this relatively equal highs. That might be a scenario where we see buy side traded to. I just don't know. Okay, so I don't have any shame telling you, and my students that have been with me for a while now know that this particular week of every single month, I'm very guarded in my expectation and my analysis because I'm more apt to be wrong. So if it's likely for me to be incorrect during this time, is it wise for me to tell you what I think is going to happen when I know that my probabilities are extremely low? It wouldn't be wise to do that, right? But as a mentor, I'm explaining to you where my weaknesses are, because I have no shame in them, because I empower myself as an analyst by knowing where I'm weak, and I do not tread in the markets where I'm weak. So if the markets are not predisposed to do things that I'm used to seeing in terms of precision and symmetrical price delivery, I'm not going to go in here and engage. So I have to give you a gun-to-head scenario like I did last night. And sometimes it sounds like both sides of the marketplace. That's what some of the critics will say. But there's conditions there in the commentary and in the commentaries that I give, not a one-sidedness that's obvious. Usually when it's not a one-sidedness, I'm telling you I'm not interested, and either I don't know, but let me just tell you what I think it might do. So I kind of like cosign each time, but right now I don't know what it's going to do. Okay, but gun to my head, it might want to come up here and rush through these relative equal highs. Does that mean continuously keep going higher? I don't know. Does it mean it never goes up here at all and just fails to go there and go lower? I don't know. Okay, so if I knew and I had confidence, then I would be trading, wouldn't I? But because I don't know, and the markets are just in a period of uncertainty for me, I'm sitting on my hands and going into my long-awaited vacation a little bit earlier. All right, here's the euro dollar. As you know, I was looking for that little movement up into here, and I didn't need it to go back up to the old low at 1.03403 level. I was only interested in this area right in here, and it ran up into it and then gave up the ghost and went lower. So why did I only have a limited expectation to go up here? Well, this thing's been held lower. It is being manipulated heavily by the European Central Bank. Cable has been allowed to rally. That means euro pound should be what? Weaker or going lower, right? If you look at your chart, you'll probably see that. That's why I felt that this is all that would be likely to be seen. That small little movement up in here. Between here and here, in that little area, that's what I was looking for. Just to bump buy-side liquidity. Go back and listen to last night's video. You'll hear me talk about that. But it went up there, failed, and broke lower. Now here, look at these levels here. Okay, that fair value gap, we're extending it through all of this. Because why? We're not supply and demand. Supply and demand would never consider cutting through all this stuff to look for a zone and I don't look at zones. I'm looking at a very specific level, that low and that high. Okay, is that ambiguous? No. If the market trades down through those levels, we can anticipate it acting as what? Resistance. Real support and resistance. Or institutional support and resistance, since you like to take my words and apply all kinds of silliness to them. Institutional candles that don't exist. All right, so we have a break below it here. Now notice there's nothing really up here for like the fair value gap or the model. Okay, none of that occurred up here. And we're going to break that down further. But we trade through it here, and then look what happens. Run back right back up into it here, and gives up the ghost and goes lower. See that? It's needed, isn't it? And on the 15-minute time frame, you can see again, nothing up here. We don't have the shift in market structure. It's just hanging around at that old level I gave you on the daily chart. It just pumps through it a little bit like I gave you last night, and then boom, gives up the ghost. Any fair value gaps in here that traded back into? Nope. How about in here? Nope. How about in here? Nope. See, nothing was left open for it. So can you take a trade in those environments? I would humbly submit I am not interested in trading these types of markets because they're not providing what? The signatures I'm teaching you that exist in high probability, low resistance liquidity run signatures. See how that works? Yes, the market has moved. Yes, the market went lower. Yes, the market went to where I said it was going to go here. But none of that equated to a trade for me. And even though it went lower, it doesn't give me any of the setups that I would be looking for. See that? So, the first one that occurred was late in the morning around London close. So we have the high, low, shift in market structure went lower, fair value gap, trade into it here, once more here, and then trades lower. Then we have a gap, trades up into it, breaks lower. We have another gap here, trades lower. That's too late in the day for me. Another one here, there, and trades down below the 1.01658 level. So hopefully this kind of like gives you a visual representation of what it looks like when I'm not interested in the marketplace. Yes, there's all kinds of little retracements and such, but it's not as clean and symmetrical as I've been teaching you and what to look for in terms of price action. So I know this probably wasn't one of the better videos, but hopefully it explains why I'm not interested in the marketplace and why it's not really delivering an exciting, very one-sided delivery in price. Yes, this market has gyrations. Yes, it's moving up and down, but it's not providing a model entry for me. And if that's the case, then I would consider that gambling if I were to participate. So I don't gamble, and I don't teach my students to gamble. Hope you found this one insightful. I'm going to be gone for a while. Don't freak out. And when I come back, I'll return back to commentaries and instructional lectures for your edification. Until I talk to you next time, be safe.